So Nate, let's talk about the buyer side of the closing statement. Let's talk about, not only just buyer closing costs, but I also want to get into where do people get taken advantage of, because, I know you guys run a very ethical, great company. You take great care of our clients. So what are some typical closing costs, and then where do people really need to pay attention to make sure that their costs are in line with what the market should be, bearing?
Okay, well, on the buyer side of the transaction, closing costs, they're basically a culmination of a lot of third parties. Believe it or not, a majority of your closing costs have no direct correlation with the lender themselves. Okay. So it's a very small percentage. So, for example, if you're buying a home, typically your costs associated with the loan, you got to pay for an appraisal, and most of them have an underwriting fee. Well, pretty much everyone has an underwriting fee. And you basically just look at the underwriting fee and the interest rate that you're getting, and that's what I would compare, if someone's looking to find out, do they have a correct deal or is their closing cost not out of line? Those are the fees that you look at, because the rest of the fees that you're being quoted are things like surveys, title insurance, government taxes. These are things that are going to be universal amongst everyone. The only difference is, unfortunately, you could very well get in front of someone who gives you some very low quotes, and you would be inclined to say, oh, wow, that's a lot of low closing costs. But all they're doing is giving you artificially low estimates for a third-party cost that they ultimately don't control anyway.
Right. So, and we've seen this happen.
Mm-hmm.
The settlement statement comes from the mortgage lender, and it shows insurance that's really low,
real low taxes,
and real low taxes. Then all of a sudden, it gets into underwriting, and they get their insurance policy, and it's $1,000 more than it was supposed to be, and they were off on the taxes because the homestead is or isn't there. Right. And then all of a sudden, it's like, uh-oh, we can't buy this house. So that's definitely something to pay attention to.
Yeah, and as far as costs go, in general, like I said, we work with about 16 different lenders. Underwriting fees, they range from probably $6.95 to maybe $8.95, depending on which one that you're looking at. But just keep in mind too, you hear these people say, "Oh, I'm getting a no closing cost loan." Now I can assure you that the government has taxes involved in every real estate transaction, and the government's not saying, "Oh, don't worry about this one, guys, it's on us."
Right.
There's costs there, I can assure you. What happens is, how is it getting paid for?
Right.
And the way that a no closing cost loan is getting the closing costs paid for is you're paying a higher rate, and you will pay more for that loan for 30 years than you could have otherwise paid if you would have paid.
So you think you're getting a saving by not having any hard costs, but in actuality you're paying a lot more than that hard cost over a few years of the loan.
Yeah, because I can guarantee you that we have a charge in there as well,
Yeah,
and that's not free.
Right, right.
So there's a lot of third-party costs that happen. And I'll tell you, this is something we see a lot on. As a lot of people have a tendency to say, I'm going to call my current mortgage company to see about a refinance because they think it's going to give them preferable treatment or a better deal. Couldn't be further from the truth. They know that you are a secluded audience, and typically they don't have to compete as much, and they don't really. But what we do see a lot of is whenever people go to do a refinance with their current lender, the current lender will not ask them to find a survey to see if they already have one, and they typically won't have them chase down a prior owner's title insurance policy either, because those lenders own their own title companies as well.
So they don't want you to, because they want to charge you.
They're going to charge more. One, they're going to charge more by you not having that, and their affiliates will make more money. And two, it takes more time with no additional increase in revenue for them. So it's kind of like the right thing to do, but from a business standpoint, it costs them money. We'll make sure our customers, we'll ask them about prior surveys, ask them if they have a prior title policy, do anything we can to save money because it's the right thing to do. It doesn't make us $1 more, but it's the right thing to do,
So what about other? So those are the majority of those costs. So again, they're going to pay prorations, similar to what we talked about before, or not really pay prorations, but the prorations are going to be taken care of. What about like upfront, like VA, mortgage insurance, FHA?
Yeah.
Some of those companies are going to pay an upfront fee to do business with them.
Yeah,
not companies, but
on USDA loans, on FHA loans, on VA loans, they do have funding fees or upfront mortgage insurance premium. And those are typically expressed as a percentage of the loan amount. They're anywhere from 1% of the loan amount all the way up to 3.3% of the loan amount if it's a subsequent use for a VA loan. However, those costs are automatically financed into your loan amount.
So it just increase. It's not an actual hard cost.
Well, it's a cost, but it's going to be financed in. It ain't like you got to bring that check to closing.
Right. So in other words, if you've got a 3.3%, on the subsequent VA, you're looking at $3,300 on a $100,000 purchase, but it's just going to make your loan $103,300 instead of it being an actual cost. And
Yeah.
that,
And
so
don't
it's,
mistake that as being a negotiable fee. Those are set by the government. Those
Right.
are not like lender fees or nothing. It's just that's what the government says. Look, if you're going to do a VA loan, here's a fee structure for these costs.
right.
That's the trade-off for having a higher loan to value, so you're not bringing in money.
Because
to
it's
close.
it's a riskier loan, so they've got to charge something
Right,
to be able to
right.
protect them in case of a default, and obviously we know that those happen.
Yeah, the VA has
Those
no
have
monthly mortgage
happened a few
insurance.
times in
Right.
Florida in the last couple of years. So again, you're listening to the Duncan Duo Real Estate